Have you ever wondered what the future of our economy might look like? Imagine a landscape where small businesses grapple with uncertainty and cost pressures they can't pass on to consumers. It's a world where consumer debt, particularly non-mortgage debt, has ballooned significantly, and retail sales growth is propelled by credit spending rather than sustainable income. Output. In this landscape, the Federal Reserve might find itself in a bind. With a likelihood of lowering rates potentially to levels still below inflation, the specter of stagflation looms. The maneuvering room of the Fed is constrained, with the weight of high government debt pressing down. As we gaze upon this investment landscape, we find stock market exposure at historically high levels, especially for older investors. Complacency seems to be the order of the day. However, amid this complacency, real assets, commodities, real estate, gold, gleam with potential, poised to outperform in an inflationary environment. Utilities and fertilizer companies emerge as promising investments, buoyed by increasing energy demand and commodity inputs. Gold, the eternal hedge against inflation and dollar weakness, continues to shine. Oil stocks, especially stalwarts like Exxon, outperform oil prices propelled by ETF flows and liquidity. In the realm of fixed income, short-term bonds of 3 to 18 months are favored over their longer-term counterparts, courtesy of the current yield curve shape. Corporate bonds are considered, but the preference is for high-quality issues with 5 years or less to maturity. As we navigate this economic seascape, it's important to acknowledge the risks. Market valuations are extremely high, with investor complacency reaching unprecedented levels. The market's indifference to stocks as risk assets is a concern. Historically, the first year of a new presidential term is the worst for markets, and neither political party is expected to significantly reduce the deficit, posing future challenges in selling government bonds. So, how do we position ourselves for the fourth quarter and beyond? Oxbow Advisors, for instance, is not significantly changing its positioning but remains cautious due to these high valuations and complacency. The favor falls on real assets, short-term bonds, and select stocks in utilities, energy, and commodities. In a nutshell, the economic outlook is cautious, with potential risks due to high debt levels, inflation concerns, and market complacency. A diversified approach with a focus on real assets and careful selection of stocks and bonds is the suggested navigation through this uncertain economic environment. Remember, the world is changing, and so must our strategies to thrive in it.